Mr. Lalit Modi said in the press that, my weekly expenses were 10 to 12 crores. That's a huge amount of money.
You've said that once a top actor in India needs about 25 crore rupees in passive income.
There's money in abundance today. I think any top celebrity, A-list celebrity today makes anything in the range of 2 to 300 crores a year. Ranveer Singh has having a super U. Shraddha Kapoor, Palmonas, Kirti Sanon in hyphen. The first generation creates wealth. The second generation maintains or grows. The third destroys.
What typically happens in terms of that wealth destruction?
Clashes of ego. The bigger the wealth, the more fragile the egos are.
Are the women now getting a little bit more involved in terms of, financial planning, involvement?
One of those days when women went to their husbands back and said, today I see they have their own portfolios. What really worries a patriarch, somebody who's sitting on 2,000, 3,000 crores of wealth, is what happens if after I'm gone. I think that's when the war begins.
Are they creating wills now, and how important is it to do that?
So I know a family where the guy was a very, very senior corporate guy. If I do the entire math, it was turning out to be 50, 60 crores, but there was nothing properly done. The wife had no clue till he passed away. I'm saying it openly on this podcast. I think largely you see banks and distributors selling it. Because
most of us are trying to figure out how to make our first crore. Deepak Vazirani is a person many of India's wealthiest families turn to once they've made 100. Over the years, he has advised Bollywood icons, leading business families, and ultra-high net worth individuals on how to preserve, grow, and transfer wealth across generations. Today, we're pulling back the curtain on that world. How do the ultra-rich really invest? What keeps them awake at night despite having more money? And where do they want to spend? Where do even the wealthiest families make costly mistakes when it comes to managing wealth? Let's get into it. Deepak, thank you so much for joining in. Welcome to the show.
pleasure. Pleasure's all mine.
So let's get straight into it, Deepak, because the numbers are quite baffling. Approximately 20% of the millionaires in India are under the age of 40. And you've spent nearly 30 years of your life inside the financial lives of the wealthiest people in the country. Tell me, up close and personal, what does it really look like? And does that stat really come by surprise?
No, it's no surprise. Looking at how the numbers are stacking up today and the way India is moving as an economy, I think it doesn't come as a surprise. In fact, we'll be surprised to see if the numbers go down. It's only going to go northwards from here. Okay. So yeah, rightly said, Avan, we have a lot of millionaires and billionaires carrying under the 40 and the 40 under 40, right? People are making money. You've seen explosion happening in the tech sector, the AI sector. A lot of people have created absurd valuations, right? So they've seen crazy wealth overnight. And it doesn't come as a surprise. I'm sure India has much more to give from here. And you go to see the numbers start swelling up more and more as we move forward. Yeah, but the whole idea and the whole experience is, how do you manage temperaments of such people, right? I mean, I have seen people with generational wealth. I've seen people with new money. The whole idea is, when you sit with these two different sections of people, I think to each, how do they look at money and their relationship with money is very different, right? While the people who are wealthy, who are born into wealth or who've created wealth in their lifetime over 3, 4 decades, 5 decades, right? For them, I think it's the risk-taking ability is slightly lower. For them, it's more of capital preservation. They believe that I have not heard any large family telling me, Deepak, how would I make a 20, 30, 40% returns on my capital invested? They say, you give me a 12% upwards. I'm pretty happy with that. Okay, so I think it's more about preserving your capital, creating a legacy to be the legacy that the wealth can be passed on to the next generation. And they're happy with you're beating inflation, you're creating a number of 12% upwards. They're very happy with that because once you touch a 15% number, the wealth compounds at every 5 years, it doubles up, right? Any which ways. And markets have done that. But if I look at the new generation of wealth creators, I think their risk-taking ability is way higher. Okay, they have seen exponential wealth and they're open to taking more risk in their portfolios. Okay, they're ready to back more startups because they've seen the valuation game unfold in a very different way. than we've seen. So their ability to take risk is very, very high. And the beauty is when you have these two generations, completely different, thought processes of two generations coming together and sitting on one table. That's more exciting.
So you're saying that the people who have built wealth at a later stage in their lives, like a lot of the tech entrepreneurs, for example, they are more risky by nature in terms of
their appetite for risk is way higher. Because they have made money, they have seen quick money. Also what happens, Avan, it works both ways. They have seen maybe one cycle of wealth, right? I mean, if you see the last 5-6 years, there has been money made. Maybe people have seen one cycle of the markets. Looking at portfolios delivering in excess of 30-40% in the last couple of years. Of course, 2 years, the markets have not really done well. I mean, it's kind of, it's stayed muted. But when you see only one bull cycle, I think what we as as advisors or as wealth managers need to tell them is to be more patient, is to change their temperament, is to instill a bit of discipline and patience into them, because they will see more cycles like this coming in. We will, because people who've seen cycles in last 30-40 years have seen cycles of 2008, have seen bear cycles. They exactly know, when the markets are beaten down, when the portfolios are bleeding in red, okay, and how to deploy more capital back then. So you need hard to deploy capital, because when your valuations are very, very down and cheap, the markets will come up sometime. And they don't give time to react. They don't give time to understand.
But I mean, with that kind of wealth that they have and the wealth that they have created, is there still at the time of a market crash lots of questions, or are they just like, do what you want, I trust you, or this is the time to invest, I've been through this before? Is the mindset different from that of an average investor?
So definitely, Aman, like I always say that, wealthy clients always have cash and liquidity in the portfolio. Cash is king, I always say that. So they always keep 10% cash in the portfolio, and that is primarily kept for taking advantage of, markets when markets are beaten down, when the markets are going through a turmoil. That's when the time they start deploying money at various stages of the market, because they see long term. They understand that markets will come back and come back in a very big way, okay?
Yeah.
So the idea is to keep deploying. I think our job is to, when you're mature investor, there are two investors. One is a mature investor who's seen cycles, who understands that. One is a new investor. He says, what next? Should I take money out of the market whilst my portfolio is down, or should I stay invested? I think it's a trust that you build in with them. And then when they trust you, then you take calls, you move. First, the money is in liquid, because the way the markets are moving today, you don't know at what entry. I mean, you're seeing the markets being on a yo-yo form, right? So in a staggered way, you move money in the markets. And I think equities is the thing to be in for the next 10, 20 years. The money the markets will make for clients is going to be very, very different from here. So I think we are in a golden phase of markets. I'm not saying today. Now, of course, now the markets are looking very edgy. They've been edgy. But yeah, I think it's a great time to keep entering looking at a long-term perspective. Definitely, yes.
So tell me what an average portfolio of an Ultra-HNI client of yours currently looks like.
I think it differs definitely from client to client.
Of course.
That's one. If I take you back 20, 30, 40 years back, when I started my career, 30 years back, right? An average client's portfolio was largely into real estate and fixed deposits, okay? There was barely a fraction of money into stocks or something. Then started mutual funds, and we've seen the numbers in mutual funds. From 2015, we were sitting on a 15 trillion number, and today we're at 80 trillion. Okay, so the markets have swelled up in a very significant way. So today, if you ask me, I think there's a good split between properties, real estate. When I say real estate, it's not residential, definitely not residential. It's largely commercial. They have commercial properties, and largely money into mutual funds. There's a bit of alternates, definitely yes. There's a bit of global exposure to global equities, your global assets, your global properties, a little bit of exposure on gold. Okay, so it's a very properly diversified portfolio, and that's what they believe in. If you ask me, they stick to the boring basics.
Yeah.
They don't want to venture. Of course, there's a lot of money now going into startups as well. They back a lot of startups, because that's, again, a fraction of money. When I'm saying on 100 rupees, if they have 100 rupees, I mean, 10% would definitely be in cash, because at any given point of time, there's an opportunity. They are opportunistic, and their relationship with money is not emotional. It's very practical. They don't take emotional decisions, definitely not. Okay. And so cash is there always, because that can be deployed at various at levels of when they see opportunities in the way in the market or in real estate or in equities. But largely, I think it's funds, it's real estate, it's a bit of startups, it's a bit of alternates, it's a bit of global exposure.
Yeah.
So it's a mixed bag of everything.
What's the maximum concentration in? You would say commercial real estate and mutual funds max?
So I think mutual funds and that play
Okay.
a huge part of the portfolio.
Okay. You said something that their relationship with money is usually not emotional. It's very practical. Do you think that that is what in some way also sets them apart from the average investor, that we have that emotional attachment to money, like we're monitoring the markets, for example, and saying, bye, look at the price of my stock. I bought it at this, now it's at this, which is a very natural thing to do. But is that what's setting them apart?
So what happens, Aman, in this case? I think who makes money in the stock market, I'll be very candid with you, I've seen over the last 30 years, is somebody who forgets about the portfolio.
Yeah.
You know, a client
Sleeps on it.
If I'll tell you cases, okay, and there's a very, very classic real life cases. You know, I was sitting with some clients and they said, "Arey yaar, Deepak, ye mera stock pada hua hai, pata nahi, I've not even seen." I'm talking about the physical stocks getting, and I'm not talking about now, I'm talking about a decade back or, decade and a half back. They said, yeah, this money was physical shares. I don't know, it was just kept and I've just inherited this money and it was bought at a dirt cheap valuation by somebody's grandfather or father, and it was just kept there. Just because they didn't do anything with that today, assuming that 10 lakhs of investment has gone into a 15, 20 crore and they're baffled. So what happens? Put it in the right stock or put it in the right fund. If you wait for it, and give it time, the compounding effect is where the magic happens in the portfolio. So I think they understand quite a bit of that. I don't think they're reckless with their investment approach. What happens, a normal investor, if he's over leveraged, and I'll tell you what happens, okay, and very, very candid, I'm going to speak very candidly here. Ek normal insan jo hota hai, when the going is good, assuming there is an equity rally that's happening, he will start putting all his money in equities. He forgets there's a balanced way of portfolio management.
But that's also recency bias that tends to happen.
100%. You see gold.
Yeah.
I mean, the gold prices kept shooting and finally when it touched, an all-time high, you had all retail participation
But
coming
did
in
a lot
gold.
of these UHNIs benefit from this gold thing? Did they catch it in time, or any of your clients, for example?
So like I said, one of the earlier podcasts I had mentioned that I missed that rally as well. Because see, gold is more of a hedge asset, right? I mean, today gold should be there, a concentration of gold should be not beyond 4-5% in the portfolio, okay? What happens when you go through a crisis time, you go through a times of uncertainty, in geopolitical situations, in today's times that we are in, that's when gold starts picking up. In the uncertain times, gold starts kicking in, it keeps, but the returns that gold has given the last 1-2 years, it's been absurd. If you see the last century, the whole 100-year return of gold, it's not been beyond 5-7%.
Yeah.
So it is not an asset which will deliver. It's an asset to have, a must-have asset. But again, the concentration of that asset should be not more than 4 or 5%. And I'll be very candid. I mean, I missed the rally. I mean, once it crossed a certain amount, I said, "Nahi, I think it's too high." But yeah, you should have some concentration of gold in the portfolio.
You can't blame yourself for having had that, because
you can't go right all the time, right? I mean,
of course. But most wealth managers are telling their clients to diversify very aggressively, but you seem to come back to a very simple formula. Keep it simple, keep it boring. Do you think that over complexity is the factor that is really the actual enemy of wealth?
Honestly not, yeah. See what happens, with clients as well, sometimes they say, "Kuch naya dikhao. Kuch naya batao." You come, you sit with them, "Deepak, show me something new. Yaar, kuch naya mein kuch karte." So that's there, you always want to participate in something new. But having said that, there's a small portion of a wealth. You should be able to take that risk in the portfolio when you're very well settled. When your portfolio is, largely spread across and largely your basics are right, your fundamentals are strong. Then you look at deploying the money in something strategically, in something more risky asset or something, but could be anything, could be a startup, could be an AIF or whatever. But what happens today, I've seen retail participation coming a lot into AIFs. I mean, you see the AIFs numbers, I mean, it's a staggering number. So what happens?
Get your fundamentals strong and then do your alternate.
So today, I've been baffled when I've seen clients' portfolios at 3 crore. The total portfolio value is about 3-4 crores, 5 crores, but you have already 1 or 2 alternative funds in the portfolio. Now that is absurd. I mean, you can't have 40%, 30% of a portfolio being an alternate, right? Once you touch, I believe when a portfolio you touch a 1 $1 million portfolio, okay, into funds or something, and then having a 10% allocation to alternates makes it viable. Okay, because what happens, alternates are something you have to give it time. It's a 5-7 year horizon of investment.
Yeah.
It's a lock-in period. It's a staggered investment over 5 years going to make, right? You also alternates, you haven't seen too many alternates deliver because, 8 saal lagte hain wo product ko mature hone mein, and then the delivery comes in. And we've seen in the last maybe a decade or so, we've seen a lot of money coming into here.
Yeah.
Also, why it is happening is because mutual funds are basically boring for clients now, for the retail, the retail participation, right? But if you see, mutual fund is the most cheapest product. It's got the least expense ratio. सबसे सस्ता product है. And if that product delivers you a 15-16% return over the next 5 years, why do you want to try something? If your portfolio is only 5 crores, build it to 10 crores, build up the basics, keep the fundamentals very strong, and then look at a slight diversification.
Okay.
I think that's also being sold quite a bit, and I'm saying it openly on this podcast, on this public platform. I think largely you see banks and distributors selling it because of the high commissions coming in there, kicking in there. Okay, being very open on this platform, because I think a lot of the times clients don't even know that they have to keep paying this over the next 5 years.
So are you saying that they're sort of trying to...
I'm not saying everybody does it, but I'm saying largely you're seeing so much of inflow coming in. Of course, yes, the appetite for clients also is going up because the portfolio is swelling up, and of course there is a need for allocation to different asset classes. But I think having an AIF... See, why did SEBI keep a 1 crore ticket size, minimum 1 crore? Because once you reach a certain level of a portfolio, then you need some diversification there. So 10% is a good diversification to have in the portfolio. Not in a 5 crore portfolio, definitely not. Over a 10 crore portfolio, yeah, you can look at a 10% diversification into alternates.
Okay, so let's say there's a 42-year-old tech entrepreneur, really crushed it in his business and has come to you with a 10 crore allocation. What are you telling him?
So I think I am going to tell him to put his money, again, depending, like he's 42, right?
Okay, and say he's saying, I'm open to risky stuff. I have a pretty strong risk appetite.
Yeah.
I want to explore AIFs. I want to explore global markets, etc.
So I think what I'm first going to do is I'm going to first ask him, because today a 42-year-old guy, he's made his money, he's made his wealth from his company. Okay, he is the face of the company. He is how do these valuations come in? Of course, a lot of investors, large venture capitalist funds and all of that, they put in money, they pump in money into startups, looking at the growth of the startup, looking at how much the startup can go up to, and largely looking at the promoter first. Yeah. So the idea is to first ensure that the promoter is covered substantially. I start with the basics.
Okay.
You're covered. How largely are you covered? Because you are going to drive this business for the next 20 years. Till you're driving the business is going to make money, right? Secondly, you say you're an aggressive investor. Okay, you're open to risk. Your business already has a certain amount of risk in your startup, right? So I think you should do a bit of diversification there. I will design a portfolio where I think...
Design it.
So I'll say, 70% I would go into mid and small caps for him. Okay, and maybe 30% into
direct
large caps.
Equities or MF?
MF. I personally don't get into direct equities, direct stocks. We do mutual funds. I think small and mid cap would be a larger part of his portfolio.
70%.
30% into large caps, okay? Or maybe, do a 50% to small and mid, a bit into hybrid, okay, and a bit into large caps. So that makes it a good diversification because he's already taking risk in his business, right? And I think if you have a very smart, diversified portfolio, I think the portfolio delivers anything beyond 15%, you should be happy with that. So portfolios have delivered 20% in excess over next 5 years. It depends on how you design and how much are you ready to wait it out.
Okay.
I think the only glitch over here is people have seen this one bull run, right? So everybody thinks that 40% is something that you can make in the market. No, you will come through. India has a great story, definitely, yes, but you don't know how the geopolitical factors pan out, right? Yeah. Today, did we know that this US-Iran war would play out for the next 4-5 months? We didn't know. Nobody anticipated that, right? But it played out. It still hasn't come to an end. So markets definitely look good in India. The fundamentals are very strong, but you don't know how. Then geopolitical factors definitely hit the markets hard, sentiments hard. So you have to factor all of that and give him that sense that, you look at a 5-year horizon, but don't expect returns in excess of 14-15%. Of course, yes, over delivery is always better.
Correct. Okay, let's talk about the celebrities. I just want to understand, because you've said that once a top actor in India needs about 25 crore rupees in passive income just to feel safe enough to retire.
Okay, so
25 crores?
yeah, that's been a factual number. Okay, so that's a factual number I've given. That is what the family spoke to me because I manage that family's money. See, actors today have a very the shelf life is about what 1-2 decades, 10, 20 years, depending on how it plays out. To stay relevant in the business, they know that today, of course, the longevity today is very, very high.
Yeah.
I'm talking about the top A++ actors. They play out for next 20, 30 years if they're in a good run. Assuming there's a downturn in the professional career. Okay, so today all of them, and I can give you names of these guys. They are very smartly diversified.
Tell us.
Being into, I'll give you names. So the top, I mean, if I give you 10 names also, you see a Ranveer Singh has having a super U.
Yeah.
Okay, the protein.
Yes,
he's got a active participation there. Okay, in a startup. You see Shraddha Kapoor, Pulmonas. You see Kirti Sanon in Hyphen. You see Ranveer Kapoor and Kevin Turs.
So that would be the younger crop is definitely
See, look at a
choosing-
Salman Khan. He's the guy who started Being Human.
Yes.
Look at a Shah Rukh Khan.
Yeah.
KKR. He's also into real estate. I know. It's not, I don't know, it's in media, but yeah, I know he's very well diversified in real estate. He's getting there. So I'm saying they're very, very smartly. Priyanka Chopra.
Yeah.
Pambil, right? You have so many names. Alia Bhatt, Ede Mama.
Yeah.
You look at the crop of actors, they understand their shelf life. They understand that they have to, be diversified to ensure that the money keeps not coming to the 25 crore number again. I mean, it looks daunting for somebody like us. I mean, somebody at a normal person would think of an aspirational number to reach 25 crores in his lifetime to be secure. But look at, from their perspective, today they're already worth 2,000-3,000 crores, okay? And they know that a 25 crore, even if they don't do anything, their lifestyle is very different than us, right? I mean, they have holidays abroad, they keep moving abroad, they have houses overseas, multiple houses overseas.
The lifestyle is
very, very different. If there's something, the kids are studying abroad, medical attention, they go to the best doctors. I mean, they are best medical, and they go overseas for medical treatments. Not that India's bad, India's great, but I'm saying their lifestyle is very different than us, right? So having said that, a 25 crore number, looking at from their perspective, is very normal. And it also has to factor that the passive income of 25 crores, how will it look 20 years from now?
Yeah.
So today it looks daunting, but 20 years from keep inflation in mind.
Yeah, I mean, actually, by some standards, some would say that it's a modest number.
And looking at today, if their net worth is so much, Aman, 20 years from now when they want to retire, or 10 years from now when they want to retire, means retire from active work, they should have this number kicking in, and you also have to factor inflation in that, right? I mean, then that number looks very normal at their level.
Yeah. So what kind of conversations do the celebrities have? Are they very involved, or do they sort of leave it up to you, or are they very focused about, how much they're making, how much is going in mutual funds? Are they monitoring their investments regularly?
So I'll tell you, I'll be very honest. I speak with the family, okay? Not that the celebs directly sit in the conversation, but the family is definitely involved.
Okay.
And they're very, very actively involved. They understand the numbers pretty well. Of course, there's a lot left to us as wealth advisors, as family office advisors, to tell them where the money will be invested, how the money will be deployed. After understanding the risk appetite, after understanding what they want to do with the money, after understanding the liquidity needs. Because like I also mentioned in one of my earlier podcasts, I mean, we were sitting and suddenly there was 7 crore deployed for buying a car. So that can come up and crop up anytime. I mean, suddenly, you want to buy a Patek Philippe. Today, the watch starts from 2.5 crores, goes to 50 crores, right? I mean, could be anything. I mean,
Give me an example of some ludicrous thing that you've actually had a celebrity say that they wanted to do. Have you ever advised against it, or that's not your place?
No. You have to be very smart in advising. So you have to play it very, very smartly.
So what would you say if someone called you up and said, I want to buy the watch?
So I think, they have the money today, okay? They are in that circle.
They don't even have to tell you. I mean, they're doing it.
They're doing it, right?
Yeah.
I mean, nobody will tell me that I'm going to,
Yeah.
hey, Sheikh,
Yeah.
can I buy this?
Yeah.
No, they're just going to buy it.
Yeah.
Then you see, where did this money go?
Yeah.
Oh, the money's gone there, okay?
Yeah.
So that's okay. I mean, so I think they're pretty well set for themselves. I mean, they have the actor fees coming in, the endorsement deals coming in. I think all of them today have their own production houses, distribution houses. They have their startups and all of that. So I think there's money in abundance today. I think any top celebrity, A-list celebrity today makes anything in the range of 200 to 300 crores a year. I mean, if all that kicks in together, right? So for them, kind of diluting and picking something at a 25, 10, 15, 20, 25 crores is no big deal, but it happens. See, what also happens is the circle that you move in, okay? I mean, you want to be there, you want to be noticed.
Yeah, you're living up to with the Joneses. So yeah,
everybody, right? So you have to own things to be relevant, to be there. So I think they live a very different lifestyle that you and I can't even think of. It's beyond a normal person's. But I think all said and done, I think they're pretty humble, they're pretty grounded. They understand what's happening, and they're very good with their investments and numbers. I should tell you that.
They're very involved.
They're very smart. They understand. I would say, if I compare a celebrity, I'm not saying celebrities back then, a 30, 40-year-old back, those celebrities were not smarter, but I think they were more heavily invested into land and properties and FDs. Today they're way smarter. They understand, they read so much.
I mean, the fact that they're in these businesses that they've created or chosen to invest in now is telling you something, that they've realized that I need...
Do you know what? They have leveraged their brand today.
Yes.
And to a level that they don't take only brand endorsement deals, they have put their skin in the game.
Yeah.
When you put a skin in the game, when you take an equity in the company, in the brand that you endorse, the numbers, the valuation goes to the next level and your equity goes to the next level.
Yeah.
So that's what makes them money.
Yeah, that is true. I think you said it right, that they've leveraged their brand in a very smart way. And
I will tell you, I read a very interesting article, Avan, and I read it years back. George Foreman, okay, a lot of people would know this guy. He was one of the heavyweight boxers in the boxing world. He clinched his heavyweight boxing title at the age of 40. He was the oldest heavyweight boxer to clinch a title of the world heavyweight boxing champion at the age of 45. That's when he got one of, and of course, we've seen Hollywood, we've seen sports celebrities, endorsing brands and having the skin in the game. We've seen Hollywood stars endorsing brands, picking up. But George, I'm talking the 80s now. I'm taking you back in the 80s. What this guy intelligently did. I've seen the story of Mike Tyson, having $450 million, squandering the money, getting negative $50 million in taxes, and then, of course, today building up his brand again. But George Foreman, what he smartly did, he was given an endorsement deal from one of these grill companies, those grill toasters. So this company was bleeding at that time, okay? And I've read this whole article. It's on the net. So maybe he was given a deal of a couple of $1 million to come and endorse the company because he was then the heavyweight boxing champion of the world. So what he smartly did is, he cut a different deal with the company. He said, instead of taking endorsement as fees and one time or what, you have a contract,
I want a piece of the pie.
I will take in my equity in the company. 40% of whatever revenue you do will be mine. And they were happy they don't have to, outright, because they were bleeding in their books. So they were happy they didn't have to shell out the money right away. They said, okay, they agreed to that. The company did so well after he came in as a brand ambassador that the company started raking in huge money. George Foreman, for the next 1.5 decades, started making $8 million a year. And the money kept kicking in for him. So almost after 15, 20 years, they bought back the equity from him at $189 million, if I know the numbers right. So look at what he refused. Couple of $1 million, maybe $4-5 million they would have given him that.
Yeah.
To $200 million, okay, when he had equity, when they bought back his equity back in maybe 1.5 decades. So that is smart investing.
Yeah.
So that's what actors are doing today.
Correct. They are definitely smarter about it. But I want to talk about things like, golden visas, getting properties in Portugal, things like that. That sounds like something only the ultra rich do. How smart is it? What's your opinion? Is it advisable?
So I'll tell you, when you talk about golden visas and all, Avan, I think the first question that comes to the mind is that, do you really want it? Okay, how advisable? For a normal person, I don't think it's advisable because I think we have got nothing to do overseas. All our concentration is in India. I'm talking about the normal,
but a bit
usual.
of diversification.
So I'll come to that. What happens with an HNI, ultra-HNI wealthy families, that they have a lot of interest in their businesses overseas. They travel a lot. And I'll tell you how cheap it is or how expensive. I think it depends on everybody's ideology. To get a golden visa in Dubai today cost you 2 million dirhams. It's about a 5 crore number, I guess.
It's less, no?
2 million dirhams, I guess. That's what I read. Okay, getting a golden visa in a Latvia in a European country cost you less than maybe a crore. So all you have to do, you have to advise, you have to invest in a company in Latvia backed by the government, okay, and just invest a crore, you get a residency visa there. Now there are two types of visas. Okay, one is a residency, one is a citizenship visa. So if you're buying taking a citizenship visa, you go to forgo your own Indian citizenship. So that is not what people do. They take a residency visa. And you can take multiple residency visas. So for a country like Greece, invest 2.5 lakh euros and you can get a residency visa in Greece. So what also it saves them is you take a Schengen visa, you get 3-6 months of or 1 year of visa. But if you have multiple trips, lifestyle trips abroad, if you have your in your global assets, you have your properties overseas, you got a children staying abroad, you have a business interest in Europe and the US, you can keep going there multiple times with your residency visa. So it makes their life easier for them.
Okay.
You don't have that 180-day thing, that NRIs have. So you can take you can have multiple residency visas. So India allows visa free in 56 countries today, but when you have a golden visa like in Portugal or a Greece or a Latvia or Dubai, but largely if you have a Schengen visa on your name, on your passport, I think you can have multiple trips without having a problem of applying for a visa again and again. So that makes life easier for them.
But we're also seeing globally capital move outside of India. I mean, that is a fact. We're talking about the global exposure as well. What is the perception among the ultra-rich? Is that now becoming something that they are leaning towards a lot more than they did before? Is that something you're even advising now?
So today what happens is, if you see Indian currency has been depreciating to 3 to 4% every year, right? For the last decade, 3 decades, we've seen that happening. And last year, I think by 11% it depreciated. So people are aware of that. Since, like I said, they have business interests overseas, they want to deleverage the currency risk. That's exactly why a lot of monies also, small percentage of their wealth also moves overseas into global assets, into global properties, into global equities. They keep their money there, parked there, because they're looking at their children studying there. Maybe they have some business interest overseas, they have assets overseas. So they always have the global exposure to investments across the world. Because if you see, you have your major concentration in India, because India, everybody believes in the India story, but also they have a lot of money deployed depending on if you have medical health care. See, what also happens when you go there, when you're traveling there, when you have a kid studying there, when you go for medical there, you go to pay in dollars all the time. So it is always good to have a global concentration of your portfolio, a bit of a portfolio, say 10% of a portfolio to global equities, global investments. So it's a thought through approach.
Okay. But given that you've spoken about this rupee depreciation as well to now what we're staring at over the last, say from the year 1991, there has been a roughly 3 to 4% depreciation over the last 3 decades. Are most HNIs holding their wealth in rupee assets, and is there a slow bleed there?
So no, rupee definitely yes. See, today, like I said, if you have concentration overseas, if your businesses are overseas, if you have investments, if you have a lifestyle that you keep moving overseas for holidays, if you have your children studying overseas, if you have your medical attention that you want to go overseas, then you go to pay in dollars all the time. So it makes more sense for you to hold a concentration of your investments back there.
Yeah.
So that also helps you leverage on a portfolio, and you benefit from the rupee depreciation as well. So I think they have a concentrated 10%, like I said, 10 to 15% global asset investment in their portfolio. Definitely, it's definitely there. And slowly they're building it up as well.
Okay. I remember the last time we spoke, it was very interesting what you had to tell me about legacy planning and what the kind of meetings that you have with those who have the next gen who will be taking on the wealth. And you said that they actually bring in the next gen from a very young age into the meetings so that they get more familiar. Tell me a little bit more about the kind of questions they ask or the kind of demands that they have, or whoever's dealing with their money, etc. What do they have to say?
So I think, like I said...
what does a meeting look like?
So I'll tell you, like when you were sitting with the patriarch of the family, sitting on, discussing your investments, discussing about, how are you going to deploy the money, discussing about liquidity concerns, discussing about which assets we go to invest your money in. What they normally do is, compared to a normal retail investor, like I always said, they actually make their second or third generation sit with them. So it's a meeting where you have the generation, the father son sitting, or the grandfather and the grandson sitting. Okay, he may be as old as a 12, as a 14 or a 16 or 18-year-old kid, but he's sitting in the meeting, is hearing what we discussing. So he understands how wealth is getting deployed, how the markets are, kind of wavering, how the markets are kind of, returns have not come in the markets, what discussions are we doing on the portfolio, how we realign the portfolio, okay, looking at the concerns in the market, or how we looking at opportunities in different sectors buying.
Yeah.
I'm telling you, I'll give a very example. I was sitting with a large client and he was saying, Deepak, we have some liquidity. I always tell them to maintain about 10% liquidity, right?
Yeah.
I mean, he said, now there's an opportunity coming because, and I'm talking about a couple of years back, and this came in the media as well. There was this big family I was sitting with, and they said, we're getting this deal from a real estate developer. He's under stress. And for example, without naming anything, the property value was at 1 lakh per square feet. And he was offered at 65,000 per square feet and a bulk deal. Okay. I said 35% straight down you're getting. And the property was a very, very premium property. Okay. It's just that they had the money. They had the money. The developer wanted some inflow coming in. They struck a deal. They got a 35% down. And the ongoing it was above a lakh, a little more than a lakh. And they bought in about 10 flats. 10 properties. It was a 500 crore transaction, or 500 or 800 crore transaction, one check. And they were only 35% in.
Yeah.
So that is when you hear, when this kid sits and understands all these deals, he absorbs all of that.
100%.
So that is what happens compared to, and I've said this in the past as well, not what happens normally with a retail investor, and I've seen this with cases, and I have multiple cases. I'm saying retail, I'm not saying retail as it can get. I'm saying people also are salaried people. So I know a family where the guy was a very, very senior corporate guy, had built his entire assets. His money was deployed across, it was scattered. Imagine being at a level of a president. And how? Because after he passed away, he just passed away last year, somebody referred his wife to me and she came and she spoke to me, and that is when I got into the portfolio. It was scattered. He forgot to pay his life insurance premium. Okay. His cover lapsed because the premium wasn't paid. His money was stuck in land. There was no proper, the properties that he bought was not registered.
Yeah.
So the money, the corpus, if I do the entire math, was turning out to be 50-60 crores, but there was nothing properly done. The wife had no clue till he passed away. Imagine at that level, the wife had no clue till the man passed away, and then she was trying to figure out, okay, what is where, what do I have?
Yeah.
And they had no kids.
Is this common though, or
very common? In fact, now now people are way smarter, but I'm saying I just saw the example now.
Yeah.
The guy was 58, 59.
And are they creating wills now, and how important is it to do that?
So it is very important, Aman, to create a will, okay, for a piece, definitely for a piece. And I'll tell you how the wills come in play, okay. Now I'm giving you a normal example. Now, I'm a person, I have made money in my lifetime. I have a wife and 2 children. Now, if I pass away, what should the normal course be? My assets, as per the understanding of a normal human being, a normal retail person, my money I have made should go to my wife and 2 children. Right? Barabar? Ye normal understanding hoti insan ki.
Correct.
But what does the Hindu Succession Act say? I'm going to tell you that. Now, what the Hindu Succession Act says, if I die, my property will be divided into my wife, my 2 kids, and my mother. If my father is alive, not my father, only my mother. Okay? Or if my father is no more. Here, I'm assuming my father is no more, okay? Because my father is no more, actually, my father is dead. So if I die tomorrow, God forbid if I die, my money will be divided. And if I'm assuming my money will go to my wife and children, yes, it will go. But 25%, 20%, and 25% of my wealth will go to my mother. Now, what happens back then? Now, if my mother is not aware of things, okay, she will want to give the money to my wife and children, okay? Here, I'm saying if people are aware of how the will thing works. My mother's share, 25%, can be claimed by my sister and her husband. So that share again can be divided. Or will be divided into my sister, my siblings, and my wife. So technically, my 100% is not going there. It will go to others if my mother is not aware, if
Correct.
my wife is not aware of it. So what a will does, it costs you barely 15,000-20,000 rupees. A will basically says that, boss, if I am no more, my assets should go to so-and-so person.
Yeah.
I have made my assets. They should go to so-and-so person. And normally when you draft a will, it can be in as simple as in a piece of paper, A4 sheet paper. You don't have to make a stamp paper and all that. And you just need two witnesses. One could be a person that you know, you trust. A second, always prefer to have a doctor, your family doctor as a witness, saying that this will has been made. He is in a proper sane mind, and he's
Yeah.
made the will in front of me, and he certifies that. So that is good enough. If you want to have another layer of security, get the will registered.
Yeah, absolutely. I think more than just creating wealth, it is important to know that the next, those after you will get to enjoy that wealth as much. That's equally
You will not
important.
believe, I have seen families getting destroyed because of
Yeah.
money, and so
And
many
then the
cases.
legal tussles.
So I, as a patriarch, I have made wealth. My children are fine. See, what happens normally, Avan, till I'm there, and I'm a wealthy client, okay? Example of a wealthy client A. He's created all his wealth, properties, assets, his businesses.
Yeah.
His children are very fine. Everything is hunky-dory between them till he's alive because he's there. After he goes away, comes the problem, okay?
Yeah.
Because how will the wealth be distributed? He'll say, okay, now I want my right of the business. He'll say, I want my right of the business. And especially your wives, you have now children coming in, their children coming.
Yeah.
Clashes of ego. The bigger the wealth, the more fragile the egos are. And I have actually sat through some of the discussions trying to get things sorted amicably. So it is so much of bad blood that goes.
Yeah.
Sometimes what happens is the brothers are good. When their children enter the business, that's where the problem starts. So idea is to advise the client to create a will and to create a trust as well.
Correct. Yes. And
Will
is the
should be done by
process-
everybody.
What is the process for a trust?
See, a trust, what happens and why a trust is created? When the wealth becomes bigger.
What is bigger?
Bigger, I think, in
Give
terms
me a
of.
number.
So
Over and above?
I think if you are 25-50 crore
Okay.
net worth, एक trust बना दो. Move assets under a trust. Okay. So what happens? A lot of these clients today have their private trust. So technically, clients that I manage are in excess of 100 crore net worth. So they move their assets under a trust. So everything gets streamlined. Everything gets protected. So tomorrow, what happens? I'm running a business. There could be a case where there's a litigation on me coming in. Okay, or after me, my children are fighting a case in the court. The court will say, boss, इसको seize कर दो, इसको ये कर दो. पहले matter solve करके आओ, तब तक assets are frozen.
Yeah.
Okay. So what happens? I mean, I have built everything. Now everything is getting destroyed. But what happens when you form a trust? Everything gets legalized in a trust. I am the trustee. I am the owner of the trust. These guys are the beneficiaries. Also, what happens in larger families could be a case of a divorce coming in, right? Suddenly the woman comes and says, I want a large portion of the wealth. So wealth is exposed. Or there could be a problem, a litigation problem that may come and hit you from out of nowhere, out of the block. So when you have a trust, when you have everything under a trust, all these monies are protected.
Okay.
Nobody can touch your assets. Because
Yeah.
the owner of the properties and everything is the trust. You're just a beneficiary of the trust. Okay, so that is when trust is very important. But a will should be made by every single individual. It is as low as a 15,000-20,000 rupees to create a will. And you can keep changing your wills if you want to. Because if you add more assets over
Yeah.
time, I think every 5 years you should assess your will and rechange it. But have a will in place.
And even you started off with a decent cover. That seems to be the number one thing when it comes to insurance. So typically, how much should you be allocating at what age, and what is the right mix?
So I think insurance is a very underplayed asset, if
Yeah.
you ask me. Okay, it's very boring kind of the way it's been sold. I think it's largely by the way it's been sold. The moment you say insurance, I say no.
Yeah.
Insurance ki baat nahi karo, because I
Yeah.
think it's been missold rather than sold rightly.
Correct.
But I think cover is very essential. When you're younger, your cost to mortality, your cost to life is very, very low. So mortality charges, your cost of cover is extremely low. So I think keep building, once you start working, keep building covers at a young age. And as you keep growing, after every 5 years, you should keep assessing your covers again. Because you know what happens after, maybe I started my example, if I'm a
Yeah,
guy,
give me.
I started young, I'm a 24-year-old guy, I've started my job, I'm earning, assuming a 6 lakh or 8 lakh package, I take a small cover of 50 lakh rupees on myself, okay, if something happens. But then to me, the 50 lakhs, today, I'm not married, comes to my family, okay. I get a wife. I get married at 30. Okay. So after 5, 6 years, again, my earnings would be about 12 lakhs, 15, 20 lakhs. And as I keep growing, my earnings also keep growing. So you got to relook at your covers and reassess and keep increasing your cover. So when you're younger, your cost of cover is extremely low. Take a term plan.
Yeah.
And keep topping up a term plan.
Yeah.
Because after every decade, so after 30, after 40, after 50, it keeps jumping hugely. You see the numbers keep changing very, very fast. So I think keep topping up and have a good cover. I think you should have your cover in 50. You should look, the basic thumb rule is 10 to 20 times of your net worth should be your cover, your annual income.
Say that again.
10 to 20 times of your annual income.
Okay.
Annual income should be a cover. So today, why do you need a cover? Is because today is something, and we're seeing people, and post-COVID, so we've seen a lot of cases, right? Today, if I'm assuming 50 lakhs or a crore a year, or 2 crores a year, suddenly when I'm not there, what happens? Does my wife have to liquidate my investments, liquidate my assets? No. If I'm having a cover of say 5 or 10 crores, okay, this money comes to my family tax-free.
Yeah.
We all work very hard for our families, for ourselves and our families, right? After we are gone, we want peace of mind for them.
Yeah.
So we ensure that we are adequately covered. Okay. So tomorrow, if something goes wrong, the money comes to the family as tax-free. Even if nothing happens to me, the money comes back to me.
Yeah.
The entire premium. So there are different products in insurance that you can offer to clients.
What about like property disputes? That's what we tend to hear about a lot among the wealthy after someone has passed, and that can tend to be very tricky to divide it, especially if there are 3 children, families, etc. Tell me some classic examples that they make tell me some classic mistakes they have made and what they should be doing when it comes to real estate.
Interesting. Very interesting, actually.
Yeah.
So Avan, we go back to the same question of having a will or a trust in place, right? Because today, if I see, and I've seen a lot of these, and I've seen real life cases, Avan. So when I'm I've done well. I have made assets over the last 40 years.
Yeah.
I started my career from scratch. I built my business to a X valuation. I've amassed a lot of properties, assets, commercial, residential. I have funds. But what happens when I go away? Then comes the distribution of wealth. And that is when the problem happens. So what do I do in my own lifetime? I create a trust. The trust decides, okay, or I create a will. The will decides, okay, this assets, I'd make a valuation first of my entire property and assets. Assuming my properties in my real estate works out to about 100 crores, for example. 100 crores of assets I have. I have about 40, 50, 70, 80 crores of mutual funds into funds. I have overseas assets, all of that. So I depending on how much I want to give my each children. My sons, my daughters. Okay, these assets will go to so I create a will. I make a will. Very simple. There's no rocket science in that. That is when that discussion, and I think today people understand. Earlier, if I saw 10 years back, 20 years back, I think there was no discussion like this because they always said, nahi, sab theek hai. So, you tend to say, sab theek hai, main hu, sab theek hai, but aapke baat kya? So, what has happened today, a lot of awareness has come in to clients.
Right.
Because they've seen happening with people in their circle. Ki ye chala gaya, iske baad problem ho gaya. Today the sons are fighting, the daughters are not talking to each other, the families are not talking to each other because the distribution of wealth hasn't happened in my lifetime.
Yeah.
Today everybody wants a marquee property, everybody wants a bigger share of the business, everybody wants to know this property is going to be mine. And then your wife, your better half, goes through all the suffering.
Yeah.
So I think they understand, they've seen we have so many cases, so many in the media, outside the media. I have been privy to so many cases. So I think clients understand. So they make a will in place, they form trust, because building wealth is one thing. Preserving wealth is another thing.
Absolutely.
So they believe in preserving their wealth.
Yeah.
And how? Because you've seen money. I have seen people inheriting 100 crores, 200 crores and squandering away all money.
Yeah.
I have seen today, wealth is gone. And we've seen with so many business families happening. Like I mentioned, earlier as well, 40, 50 years back, there were huge families. Today we hear about the Adanis, of course, Birla has been around for the Tatas and Birlas have been for the longest time. Reliance has been there for 30, 40 years. But we have heard a lot of new families coming in, right? But 50 years back, there were more families, there were more names. Where are they today? Where's the wealth today? So it's all been diluted.
So tell me what typically happens in terms of that wealth destruction, especially like squandering away of a lot of the wealth or family disputes. How is that wealth typically being eroded with the ultra HNIs or the very rich people?
I think when, Avan, when we don't have a will in place, when the patriarch or the matriarch goes without a will, goes without, allocating assets
Yeah.
properly, I think that's when the war begins. Number one, if the wealth is not invested wisely, because they have a certain lifestyle. See, if you're born with a diamond spoon in your, right? So what do I say? The first generation creates wealth. The second generation maintains or grows. The third destroys. Why does it destroys? Because he's never seen a setback in his life.
Yeah.
He's been born
No adversity.
in luxury, right? So when a setback hits him, he doesn't know how to handle that. Also, he is used to so I was just reading in the press somewhere, Mr. Lalit Modi said in the press that, my weekly expenses were 10 to 12 crores. That's a huge amount of money.
Yeah.
Because he said I was born with a diamond spoon. Now, I'm not taking that example here, but I'm just saying that is the kind of lifestyle they live in. So unless you have invested wisely, unless you have the division of wealth in the right way, okay, if there are disputes that come in later, the court intervenes for settlement of the disputes. And that's when the assets are frozen. Okay, and it comes in because at that level of wealth, egos are very fragile.
Yeah.
Okay, very fragile. I've seen siblings not talk to each other face to face, not talking to each other.
Oh, yeah.
Small things, right? Because the wealth is so massive that they want, and they don't come on the table. You have to have a mediator coming, bring them on the table.
Yeah. Money can ruin everything, even
You won't believe.
relations.
I have a client wherein a father and son don't look an eye to eye with each other. Imagine getting a meeting with both of them on the table. It's taking me 6 months. I go to the father, he says, take his time. I go to the son, take his time. And both of them don't give me a proper time. So I said, God bless you guys, sir. I'm not going to handle your money this way. I mean, you both have to understand they're staying under the same roof, but they don't talk to each other. Yeah. So egos. So I'm saying as the wealth gets bigger, it gets very difficult. And it's not easy. It's not easy. Our job is not easy to because we manage egos apart from managing money as well.
Yeah, I would imagine that would be a big part of it.
Huge part of it. Managing relationships, Avan, managing egos is equally important as managing money. I mean, talking about, I'm saying not everybody, 99% of them are very nice, very humble, the first generation. But at certain levels, you have to manage.
Is there a visible frustration among the wealthy when it comes to high taxes, bureaucracy, policies, etc. in India?
See, today, I think they all have come to terms that if you make wealth, you have to pay tax.
Yeah.
Okay. I don't think there is visible frustration. I don't see that. No. I think they all are clean people. People that I deal with, okay, they're happy to pay taxes. They're happy to create, because India today is giving opportunities to create more billionaires, right? And then it was 30, 40 years back. So I think we're in the golden phase of the country, the golden era of the country, I say. So I think they're happy to pay their taxes as long as the wealth is getting created. So I don't see frustration coming in, because the wealthy, if they are wealthy, they make wealth, they're taxed, and they're okay to pay taxes.
Okay, fair enough.
So unless those early days, when the money was siphoned, gone through hawalas and the monies are moved through the companies are moved to Cayman Islands, Mauritius. I think those times are gone. I don't see that with the clean people. Not at all.
Okay. What about tax saving? Are they doing something unique in terms of tax saving? What is their approach?
So tax saving. If you see, I had mentioned this earlier. I think the most beautiful way of tax, you can't say tax saving, a tax deferment structure. We do it through insurance.
Okay.
Is the employee structure.
Okay.
Okay. Now what happens in that, Aman, primarily is that you have a company, you run a company.
Yeah.
You make profits and you pay tax.
This employer-employee insurance, correct?
Absolutely
so
right. Absolutely. I'll tell you how it works. So now what happens, if you've heard of the Keyman structure used to be a very, very basic structure wherein I'm the company, I appoint a keyman from the company. Keyman is largely a promoter of a company. Okay. I take a term plan in his name. The company is the owner of the policy, takes a term plan in the promoter's name. In terms of any eventuality that happens to the promoter, as the basic definition says, to indemnify losses of the key perceived individual. Okay.
Yeah.
So if a death happens, the money, the death proceeds of the cover comes in the company, which is taxable.
Okay.
Okay. Very simple, very basic. The premium that the company pays, they claim as an expense under section 37, subsection 1 of income tax. That was a plain definition of key man. Now coming to employer-employee structure, the definition says that the employer has investable and insurable interest to park the money on behalf of the employee. Now, employee here is the promoter. Why? Because the promoter, owner of the company, draws remuneration, salary from the company. He becomes an employee in eyes of the law. So he does this structure. So now what happens is, if you have a profit, assuming, you can take or reduce 30% of the profit, claim it as an expense under section 37(1). So if I'm paying tax on 10 crores, now if I've taken 30% out as an expenditure under this structure, I pay tax only on 7 crores.
Okay.
The 3 crores I show it as an expense, I park it out of the books. And I can do a deferment. I can defer my taxes for the next 8 years, 10 years, 12 years. And then eventually when I have to take money back in the books, I pay tax. So it's a business expense taken out. And when you take money back in the books, it's a business income.
Okay.
You pay tax. But what happens is, I treat this expense, I invest this money, I take a cover on this, okay, so I'm also covered. I will ensure the money is deferred for the next 8 to 10 years, so I defer my taxes for the 8 to 10 years further. And I also create a pool outside my company books. And in terms of any eventuality in my company that happens in future, this money cannot be touched by any banker or lender. So I securitize and ring fence my money as well.
Yeah.
So this becomes a beautiful tax efficient or tax planning method.
Okay, and we've seen a lot of the wealthy now pledge their money toward philanthropy, charity. How much of that is actually happening on ground, and is it a reality? Should there...
Definitely reality. Yeah. Definitely. So what happens is when you create the kind of... See, what happens when you reach a certain level of money, Aman? You know, first the idea is for anybody is to make money. Once you reach a certain amount of money, once you have everything that you can think about, I think then it's about giving back to the society.
Yeah.
I think that has been done by everybody. I think in their own ways. I've seen people who are middle class people also, giving away charity in their own way, not in an unstructured way. So I think at this level, when you create this kind of wealth, you have a more structured approach towards charity. You pick up a cause that you look forward with all your heart to support. And could be various, could be causes of education, could be causes for the girl child, could be causes for cancer.
But are the ultra
absolutely,
rich, they are absolutely
absolutely. You see it.
How much percent of their wealth?
I think
typically
depends on family to family. I think look at the Azim Premji Foundation. He's given away so much of it. Look at the Tata Foundation.
Yeah.
The Tatas, the Azim, the Shiv Nadar family, right? I mean, there are certain families who are giving away a large portion of their wealth, lot of portion of the wealth away to charity. Overseas, of course, we have so many names. We have Warren Buffett Foundation. And look at the money he's given off today.
Yeah,
okay. But having said that, back in India, a lot of people have foundations. And I think depending on family to family, the percentage differs definitely. But everybody is very conscious of the fact that they give it back today. In a very structured approach, they give it back to the society.
Okay. Let's get into the last and final question. You're currently managing about 16,000 crores in AUM.
1,600 crores.
Sorry. Let's just get into...
I wish it was 16,000.
Okay, so I just want to understand from you, are you getting a sense that the rich or the ultra-rich are actually content, satisfied, happy, are not on that hedonic treadmill? What is it that you're observing now? Are they becoming more conscious about the lifestyle that they're living?
I think everybody is more conscious about their health today.
Yeah.
Okay, so that takes a priority today. I mean, I know one thing that Rakesh Jhunjhunwala said, and I love that man because we called him the man who taught people how to make wealth in the equity markets. He always said, one thing I always ignored in my life was my health.
Yeah.
He went away too soon, too early. A good guy gone too soon. But so health is a top priority for everybody.
And you are seeing that now, that they are taking their health
absolutely
into their own hands.
Everybody, every single person today eats healthy.
We've seen it, this fitness trend and everything. Everyone's conscious.
Everybody's conscious. Everybody understands that if they have to live longer, if longevity comes with good discipline, good exercising, good eating habits, and of course you have your cheat days as well. But yeah, I think people have been more conscious towards fitness today.
Okay.
At that level, because today everybody wants to work and they work for passion.
Yeah.
You know, the beauty about guys when I sit with clients, that they don't work for money anymore. They work for passion because they're driven towards building something, towards making something very big, and towards adding more value to society. You know, and also giving towards charity. That's something very close to their heart, and they support it wholeheartedly. Okay, but they also form trust for that. So there's a lot of discussions coming after I'm gone. If my children don't support what I want to do, so we give them advice to create a trust. There's a certain amount of wealth that goes there, and the trust in their lifetime and post their lifetime will keep doing the charity that they want to do. So there's a very structured, thought-through approach, and health comes priority.
Are the women now getting a little bit more involved in terms of financial planning, involvement, where the assets are? Are you noticing that, especially
100%.
In larger families?
That, in fact, I would say every woman should be financially independent. You know, gone are those days when the women went to their husbands back and said, "Boss, I need 5 lakh rupees to pick up something, to shop something, or 10 lakh, whatever. Today I see they have their own portfolios. So when I sit with them, they have their, whatever, they get from their husbands, of course the housewives, they have their own portfolio today. They sit on with me, I sit on their portfolios. They understand where the money is getting deployed. They understand the returns that they're going to make. So that is happening at that level. But I want every woman, today women are independent, right? I mean, they're in a different league of their own. So I think in metros I've seen that, lot of that. So I'm seeing women today are very financially savvy. They're financially independent, and they should be as well. They should be as well. Okay. They should know where the money is going.
100%.
So I think gone are those days when they went
they
to their
are
husbands.
More active 100%. Now and more involved.
Gone are those days when they went to husbands. Oh, I knew. Today they buy it from their own portfolio. They say, Deepak, I'm not going to ask him. Sorry. Okay, how much my portfolio? How much can I liquidate? I want to buy this. I said, ask him. Ask the boss. I said, no, I want to buy it from. So that is what the change I'm seeing in women today.
Okay. Let's get into a rapid fire then, Deepak. What is the one asset class that the ultra rich never put their money in?
I think the asset that they don't understand.
Okay, good one.
I think crypto is something that I don't understand. I have rarely seen anybody putting the money in cryptos.
Yeah. One financial mistake that the wealthy make that they never admit to, maybe?
I think over-concentration in a certain asset class. Sometimes being less diversified and all in the business.
Okay. One smart financial habit that you notice in the Ultra-HNIs that you think others should adopt as well?
I think to keep cash.
Oh.
Liquidity.
I thought you'd also say that they don't look at money emotionally. They look at it practically.
So absolutely bang on.
Both.
I think both. So they don't make emotional decisions. They make very practical decisions. Right?
Okay. A myth about Bollywood and what you want to bust when it comes to their investments?
I think people think that Bollywood guys are, they're dumb, but they're very smart in their investments. They're smarter than what we think they are.
Okay. What is the last thing or last piece of advice that you gave an ultra-rich investor?
I think buy your peace of mind through money. Very interesting, I'm going to tell you. See, one thing that money can't buy, what I think is relationships.
You planted a question in my head. Does it still exist, though, this... if I may, like very sexist way of in these big families that the fathers, when they have sons, that they give a larger division of wealth to them, even when it's, say, a son and a daughter? Or is it equal now?
Today it's equal.
It's equal.
Absolutely
okay,
equal.
Okay.
Absolutely
Good
equal.
to know. Yeah.
I'm talking about the metro because I've handled a lot of metro clients. Absolutely equal.
Okay.
The daughter and the son is same. I think if the son is on the board, the daughter is also on the board of companies. Yeah. She handles a similar part of the chunk. And I think they treat both equally.
Okay.
There's no discrimination. Back then, there used to be son, daughter. Today, no more.
And one piece of advice that you want to give people when it comes to investing?
I think stick to the basics.
Yeah.
Stick to the basics. You would get a lot of, people will come telling you, try something exciting. Stick to the basics. Leave the money to make money for itself. So money compounding, sleep over it. Of course, realign a portfolio. Look at a portfolio every 3 months. Understand it. And stick to the grounded basics. This country will make you rich.
Okay.
You are in an era of the next 2 decades that going to make all of us super wealthy.
Okay.
So stick to the basics.
Deepak, it's been a pleasure interacting with you. Thank you so much for that.
My pleasure. Absolutely, Aman. Thank you so much.
Lots to take away when it comes to the habits, the mindset of the ultra rich when it comes to investing from Deepak. He said that generationally wealthy families usually look at capital preservation and legacy management versus investing in riskier assets, whereas those who have made newer money tend to be a little bit, have a higher appetite for risk. In terms of division, it's usually in commercial realty, mutual funds, AIFs, global investing, gold, and yes, a 10% cash component is pretty much there across the board. The relationship with money when it comes to the ultra wealthy is not emotional but practical. It's important that they just sleep over their investments and don't keep monitoring it on a day-to-day basis. The fundamentals, get your basics right, that is important, and then look at interesting asset classes. It's important as well to create a will and have complete clarity. Insurance, very underrated, but the right cover is needed. About 10 to 20 times the annual income should be your ideal cover. And do remember to buy peace of mind. That is, of course, the most important, that no amount of money can actually buy you. I hope you enjoyed watching this episode. Do remember to like, share, comment. Tell us your thoughts in the comment section. Catch you in the next episode. Subscribe to the channel. Thanks for watching.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.